Scott, thanks for taking some time to join me on the podcast.
Thank you for having me.
Maybe for folks who haven't heard the first discussion you had with Mitchell, maybe just a little bit of a kind of who are you, what you do at Global X would be great to frame the conversation.
So who I am is someone who has been in and out of both the public and private sector. I started my career, interestingly enough, at the Federal Reserve Board of Governors in Washington, D.C., while I was studying finance, so a full-time, effectively co-op student, and then became an investment banker. Took what I thought was going to be a year off and did a master's degree in war studies. And then turned out that that would be the next decade of my life, where I did a PhD in public policy and behavioral economics at Michigan, and then taught at West Point for a number of years at the U.S. Military Academy, and was the research director for a small nonprofit called the Combating Terrorism Center, which is now the Army's Combating Terrorism Center, working across government. And then came back into the finance industry. And after working with groups like DARPA and Special Operations Force, tried to leverage the experience that I had to come up with what I would hope to be slightly more creative approaches to investment management. And so spent some time at BNY Mellon and then Morgan Stanley, and now Global X.
And your role is head of investment strategy. Practically speaking, other than appearing on wonderful podcasts like this and having steak dinners in Melbourne when you're on the road, what does that entail day to day?
For the record, I prefer the kangaroo dinner over the steak dinner, okay. But I know that that puts me in a little bit of a weird category. So
we'll keep trying.
just don't overcook the kangaroo.
Yep.
Just nice and seared.
Yep.
That's the way that it works well. But from a day-to-day basis, a lot of it is spent trying to discern what is going on around the world and where in particular we either have products that I believe and my team believes can perform well for investors, or alternatively, where can we build new ones? So it's a little bit of both, but it's basically taking everything that is swirling around us, which I use the word swirling on purpose right now, because that's certainly the way it's been, and figuring out what are the most important factors that are likely going to drive returns and, quite frankly, psychology.
Well, that kind of ties in well with your background and research. One of the things I noticed in the presentation that you gave here in Melbourne today is this idea of like, we kind of bluntly categorize it as like, or give it a mantle of American exceptionalism. And for what it's worth, I'm a big believer in this. I think like the work ethic, the willingness of people to be entrepreneurial and be rewarded for that is extremely important to the American economy and to the global economy for that matter. How do you think about that persistence through time? Like, are you still optimistic? Like, say, if we take this at any point in your career thus far, are you still as optimistic as you probably once were?
I am still highly optimistic about the U.S. economy, and I still believe in the U.S. exceptionalism story. Since 2019, the U.S. has grown almost twice as fast from a GDP perspective as the other G7 countries. And I don't think that's a fluke. I think that is a structural feature of the U.S. because the things that drive our dynamicism are, first and foremost, you nailed it, innovation. And second of all, a consumer that just keeps going. And ironically, the consumer is really driven by hard data. And I'm going to set this up for a minute because I'm going to draw a contrast between hard data, so fundamental economic information, versus soft high-frequency data, which tends to be survey-focused. And so people focus on these surveys because they're inherently forward-looking. How do you feel about the economy? How do you feel about investing in your small business? And there's a lot of information to be garnered from that. But the reality is the US consumer in February of 2022 felt terrible. And yet they were still spending and driving the economy. And so right now, it's actually in the last month basically was the second lowest consumer sentiment number for the United States, following February of 2022. And so you look at it, but meanwhile, retail sales, goods sales, they're all good because we don't follow sentiment, we follow jobs and opportunities. And so the United States continues to create opportunity for people. So I do fall into the camp of continued U.S. exceptionalism. That said, obviously, we had a very, very difficult political choice to make last November, where there was a decision made, but, like asset management, there was constrained optimization, right? There were two choices on the ballot. The United States made a decision, and in large part, they voted what they thought was an economic decision, an economic regime. And I'm still a believer that the regime can deliver, but I am also increasingly conscious of the fact that a lot of the assumptions that we had, a lot of the consensus wisdom turned out to be wrong.
How about then if we take it through one presidential term and we take a multi-decade approach, which I imagine a lot of your thinking is around that because there's like the macro, the fundamentals, all that stuff. But fundamentally, like if we look at, say like FANG stocks, right? Huge winners. We often joke here in the office, like around the other side of the world, that if Microsoft shut down, the whole of Australia would shut down overnight, right? It's basically the size of our country, right? And so that just doesn't happen. That takes decades of continuous innovation, political willpower, trade, and a mutual understanding between countries. And, I think because everyone that listens to this podcast, Scott, is kind of the same opinion that we're investing for decades, right? And so I guess does that optimism, we've got this decision that was made late last year, but does the optimism that you speak of, does that extend kind of to that time horizon for what America represents, not just within the country, but externally?
Well, I think that's entirely why I have this thesis is that it's not about a single administration.
Yep.
The current White House has a predisposition towards tariffs and quite frankly, something of a command economy that they believe that they want an outcome and they can use policy to deliver it. But what is amazing about the United States is the economy is so dynamic. Companies are so profitable that it operates, to your point, not on a single administration, but on a decade and 2 decades. Just 5 years ago, so the average profit margin for S&P 500 companies in the 2010s was about 9%. It's now 12%. For the record, back in the 1950s, it was about 6%. So it took 60 plus years to get 3% of margin expansion. We've just done it in the last 5. And we continue to forecast this, despite the fact that GDP forecasts are being revised down, earnings forecasts are being revised down. What hasn't really moved much is profit margin expectations. Companies are not revising down their expectations for profitability. And what drives stocks higher? It's 2 things. It's earnings or cash, and it's profitability, because that's your margin, right? So it's a combination of growth and profitability. So I do think we are in a world that is so much more dynamic than any single regime. And the way I kind of characterize it in my head is we are transitioning from the information economy to the automation economy. And that, the information age, it's over.
That actually is a point that I heard fell out of your presentation that you did today. which is that not just are you kind of you're optimistic about US economy and business writ large, but also around the evolution of AI and where we sit on that curve of adoption. So I'm happy to take this in whatever way you think, but if you think about like an adoption curve, S curve, like however you want to frame this up for yourself, where are we at with that? Not just, as we're recording this in June 2025, we should say, if you're listening to this later, where are we at with that now? And maybe I'll have other questions that fall out of that, I'm sure.
So we are still super early days.
Okay.
The way that I advise people to think about it is the AI ecosystem. It's not one company. Everybody thought they owned Microsoft with ChatGPT and NVIDIA for the processors, and they were all set. And then what happened in January of this year? DeepSeek rolls out and hits #1 in the App Store for a very, very brief period of time. ChatGPT is still, I'm pretty sure, #1 in the App Store, okay. And DeepSeek is somewhere down at like 45.
Right.
So, but there was this moment of realization that was maybe this isn't the killer app. Maybe there's still a ways to go here. And we believe that to be the case. But this is also why I draw the distinction between the information age and the automation age, because ChatGPT or AI, however we want to think about it, is one part of automation. It's the automation of the cognitive. Robotics is the automation of the physical. And the more that those things are brought together, that's where we're going to see continued innovation, margin development. So, for example, in the waning days of the information age, which I would characterize roughly from about 1995 until 2020, in the waning days, asset-light businesses like media and entertainment and software had the best margin expansion. In the last 5 years, the margin expansion is not where people are paying attention to. It's in asset-heavy businesses that are becoming asset-lighter because of the automation capability. So think about this. The technology of the information age gave us more data than we ever had access to before, and it helped to inform our decisions. The technology of the automation age makes the decision. And so that is a fundamental shift. And so people wonder why, for example, or Microsoft and Amazon, since you brought up Microsoft, Microsoft and Amazon spending billions and billions of dollars on data center build out and digital infrastructure. And it's because they are building themselves into the utilities of the future. They would love to be the next generation, the next iteration of technological advancement, but they're not sure they're going to be. So what do they have? A ton of capital and a very, very clear roadmap, which is we need more data processing capabilities. And so they're saying, look, we were the platforms, and they disproportionately, if you look at the technology and the communication sectors, they disproportionately grew their profits relative to the rest of the economy from 1995 through 2020. Disproportionate winners. They were the toll takers. And what was it? Apple helped you access the internet through your phone. Google helped you find what you wanted through search. Microsoft was your content creation platform, right? Through your Excel and your PowerPoint. And then Meta allowed you to share it. Those platforms in a world that is automated, not information powered, but automated powered, that world, those platforms were potentially less valuable. So they're building themselves in, and that's why they're spending the money, because they see the writing on the wall that automation is the future.
Interesting. So this kind of, I always think about like professional active fund managers, right? As in like they have seasons and you kind of make hay while the sun shines, so to speak. In particular, like a lot of great fund managers over the past 20 years have been really bullish on internet adoption, capital light business models, SaaS business models, these types of businesses, ERP, and they've ridden that wave really well. So you're suggesting to us that we're now at a point where those businesses are trying to become the infrastructure. Meanwhile, we kind of wait and see what kind of is that next iteration of that, maybe not killer app, but something like that. Maybe this is a butchered way to ask this question, but how do you and your team monitor for what that? Do you monitor for that, what that kind of killer app might be, or like that product or service, or are you more like, we're an ETF business, we are looking for the thematics, the broad-based structural changes in markets?
It is largely the latter.
Yep.
We are not trying to find the next killer app. We do have analysts that are constantly evaluating. For example, I use the phrase the AI ecosystem. So what is that? It's software, it's hardware, and it's data. And it all comes together to produce an outcome that we all use as ChatGPT or Grok or something else. But it's not about a single company winning. It's about how that transition filters through the economy. And that's why I think about it as ecosystem, because we can use the app, but powering the app, well, that's a whole other story. And by the way, what are we saying by powering the app? Are we talking about the data center, which obviously has to power the app, or cloud computing, something along those lines? Or alternatively, are we actually talking about the power and where it's coming from? And in the United States, like, we are drifting towards a nuclear future where uranium and enriched uranium and the capabilities of small modular reactors could prove infinitely more important in powering data centers into the future. And just last week, I want to say it was maybe Amazon and Constellation announced a deal. Microsoft is looking at funding the reopening of the reactor at 3 Mile Island, right? Reactor number 2. So there's recognition that when I say powering, there is the actual data dynamic behind it, but it's literal powering. Okay. And I don't agree with Donald Trump when he said we're going to power AI with coal. I desperately hope that's not the case. So I do think it's a liquid natural gas, LNG, and master limited partnerships, right? That entire infrastructure, but also nuclear that's going to drive it. So when we talk about AI, for me, it's a much broader category than simply saying what is the app that we might like at any given time, because that becomes the trap that we fall into, because if we're early stages in the adoption curve, something else is going to come out. And I think that's why the mega cap tech companies are investing to build themselves into the infrastructure, into the utilities, because they see that too.
I've got 2 more questions for you, Scott. One of them is briefly what we touched on off air, which is, given your background in research, your professional working background, it's multifaceted. When you think about finding comfort and getting comfortable with the long arc of, innovation, and even if you just put it simply, like, a lot of people that listen to the show would just be looking at the returns, like US outperforming every other market over 30 years. How sustainable is that? Like, when we hear things in the news and what have you, I guess the question I'm trying to ask is the framework or the process that goes into how you think about the world and getting comfortable with that.
So there is no single answer to that. For me, and I appreciate the way you phrased the question, it's not about a source, it is about a process. And it's about taking advantage of all the data around us. And that could be, again, soft data like surveys. That could be hard data like GDP. And we're going to get inflation numbers, as you said. We are early in June. And so in the next couple of days, the United States will get some more information on producer prices and consumer price inflation. So irrespective of the data source, it's about putting pieces of the puzzle together and recognizing when there is opportunity in particular when others don't feel it or don't see it. And I think we're sort of there right now. If you were to ask my opinion without putting numbers on it, I think the path of least resistance for U.S. markets is higher over the next couple months. Now, it is contingent on the U.S. and China being able to have their détente on the trade front. If, in fact, we find ourselves back in a situation where, the two countries are escalating, maybe I would get more conservative. But when you take the mixture of everything that's going on around earnings, around company guidance, around profitability, around AI, and around automation, and you put all of that into a stew, my answer is the United States can probably continue to outperform. Now, we'll see. I don't expect it to move up in a straight line. Profitability shouldn't. Companies will reach a point where they get pushed to a limit and they'll have to pull back on their profitability. But there isn't really ample evidence of that right now. And there's a significant amount of bearish sentiment still in the marketplace that, quite frankly, is waiting for the next shoe to drop. So expect volatility. If you expect it, then when it hits and it happens, you're ready for it. And it's not uncomfortable. And so how do you get comfortable? You take everything you can from an information perspective, from everywhere you can find it. And then you recognize that we are in an environment that I can only characterize as a roll with the changes. Right? And that's where we're at. I'm not entirely sure what the next major announcement's going to be. I'm not sure anybody is. But it'll be something, and it'll roil the markets. But if we focus on those long-term secular themes and recognize that the economy is bigger than any administration or any person, and globally for the record, so we can, I believe that the flow out of the United States is warranted only to the extent that people are trying to bring it back to an equal weight, because people were so overweight the United States. Every single company that went into the United States to sell to our consumers kept their money there. Why wouldn't they? It was a great economy. It was a great investment option. And now people are looking at it and saying, well, maybe the United States isn't quite as great as it was. It probably is, and it's probably fine. But the United States, from just a revenue and market cap perspective, has captured increasing amounts of international investment dollars. So I don't see the flow out of the U.S. so much as a vote against the U.S., as much as maybe it's actually time to go back to something like an equal weight. The flip side is that's going to create opportunity, right? And we can finally buy growth that is profitable. And it is a record high where you could buy high margin growth stocks. Usually, historically, you had to make a sacrifice. You could buy value that had cash flow and margin, but no top line growth. Or you could buy top line growth that made no money. Wait a second, you're telling me now I get to buy growth and make money at the same time? It's basically never really happened at this extreme in history before. So I find that to be pretty compelling. So I'll take everybody's bearishness and go find where those opportunities are to buy profitable growth.
Love it. My final question is actually just around, you mentioned the end of the information age and start of this kind of automation age. I think a lot of people look at, say, like China's manufacturing capability and just other parts of the world, not necessarily the US, but just other parts of the world. I remember 3D printing, and those companies had a lot of promise, and to an extent they still have use cases and what have you. the positioning of the US in that sphere, I feel like leaders in technology, obviously, does that also, are you still optimistic about that kind of overlap in the Venn diagram, so to speak, like where that tech meets with the manufacturing capability, the robotics capability? Is that something longer term that you see forming around the US as well, much like the internet age has?
I believe it to be the case, but I also believe that it is going to be an international phenomenon.
Okay.
Anecdotal story. I grew up in Suffolk County, Long Island, which is sort of the downstate rural version of New York, in a sense. And my kids wanted to go to Conveyor Belt Sushi in Suffolk County, Long Island, near the mall, which I humored them, and we went, and I crossed my fingers. It was actually pretty good. But when we ordered drinks, because you would imagine I would definitely want a drink if I'm going to eat Conveyor Belt Sushi in Suffolk County, Long Island, it was delivered by robot.
Yep.
And while a novelty in a sense, it's also highlighting the fact that in the most unlikely of places, there's automation taking place. And it's going to be across the board. For example, people don't think about infrastructure development as an automated industry. But if there are algorithms that are suggesting plans for bridges that use less materials or change the material itself into something we can produce that would be more efficient, and then automate the building process with robots that can lay bricks. It's so, the opportunities ahead are massive, and I believe they're going to be ubiquitous. We're not going to see it right out of the gate, but it's already taking place. And actually, one that's sort of first and foremost is in defense technology. Because in national security and defense space, you always have to be on the edge. You always have to be leading, because if you're not, you're behind. And we're learning a ton about automated and autonomous warfare based on what's going on in Ukraine and Russia.
Yeah.
And so that's an area that people don't think of as first and foremost for automation and AI, but nonetheless, it's playing out in real time. So I think that there are so many different pockets of the economy, and so that's certainly on the leading edge, but it's all going to go in the same direction. It's all going to go towards automation. It doesn't necessarily mean, by the way, everybody's going to be out of a job. So far, the data suggests that, roughly speaking, for every job that's eliminated through automation, it turns out technology creates 2 more. And for financial advisors, for people in the finance business, trust and the human connection is tremendously important. And what is the biggest impediment for most people's success as investors? It's behavioral economics. It's their psychology. It's the idea that you should run for the exit rather than staying invested. So I remain optimistic, not just about the US, but more broadly about international and automation and the technology that delivers. And we probably shouldn't go running for the hills. We should probably stay invested, just figure out ways that work for your risk tolerance, whether or not it's something like covered calls or a low beta theme like defense technology, or broadly speaking, diversified across the market, or narrow in and find some growth at a reasonable price. Like always dependent on an individual that could work for them in the market, but to stay invested.
You've covered a lot of ground today, even in this short interview, Scott. And I know you've just flown out from the US, and you've been on a bit of a rapid tour of Australia. So once again, I will highlight to you that lobster roll at Supernormal is very tasty if you get the chance here in Melbourne, mate. And next time you're in town, I'll treat you to one. But I really appreciate you taking some time to share some of your knowledge and wisdom with us, mate.
Been great to join you. Thank you so much.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.